Pin bars are perhaps the most famous candlestick, and this is because, quite simply, they are very consistent. We can see the real body and the wick of the candle here. If you want to learn more about candlesticks, then check out my other video, Understanding Candlestick Charts for Beginners, which is on my page at Decisive Trading. For a pin bar, the tail should be at least 2/3 the length of the candle. The body should make up 1/3. You will find a bearish pin bar after a bullish move in the market. The reason the candle works is because the large wick shows a strong surge of sellers coming into the market. This suggests that the bears may be gaining control. A bullish pin bar is the same, but will be found after a bearish move. Any nose should be really small. It should also be noted that a pin bar is not a doji candle. Even with a small nose, the tail is still 2 times the length of the real body. After a bearish move, the pin bar will appear, suggesting that the bulls are taking control of the market. This is a type of bearish morning star setup. This is the equivalent bullish setup. A bullish setup first has a strong bearish candle. This is followed by a long-tailed doji candle. The doji candle should be contained within the real body of the previous candle. This is followed by a strong bullish candle. Why does this pattern work? Well, the doji candle shows that the bulls have stepped in and tried to push the market higher. Although they failed on their first attempt, the bears also failed to push the market lower. This is shown because the doji is contained within the real body of the previous candle. It suggests that the bears are losing strength. The strong bullish candle forming after the doji candle completes shows that the bulls have taken control. The bearish setup is the same idea but reversed. Note that the doji is now upside down. Okay, next candlestick pattern. This is a bullish piercing pattern. This pattern begins with a strong bearish candle. The next candle gaps down at the open rather than opening at the close of the previous candle. The bullish candle, or piercing candle, should then close at least 50% into the real body of the previous candle. So, why does this work? The gap down suggests a strong selling pressure. However, the candle then closed bullish, which shows that even though prices gapped down, the bears couldn't maintain control of the market. A bullish piercing pattern is simply reversed. This is a bullish engulfing pattern. The bullish candle is larger than at least the previous 5 candles. It can be said to engulf the previous candles. Why does this setup work? Quite simply, the bullish engulfing candle shows a strong surge of bulls coming into the market, showing a change in market sentiment. The bearish engulfing pattern is simply reversed. This is a bearish 3-method candlestick pattern. The first candle is a strong bearish candle. There are then 3 bullish candles, all of which are contained within the real body of the first bearish candle. There should then be another bearish candle. This candle should be equal to length to the first bearish candle, or very near to equal in length. And why does this pattern work? The 3 bullish candles show the attempt of the bulls to control the market. Since price is contained within the first bearish candle, you can see that there is little bullish sentiment. The next bearish candle confirms where the strength is held, and confirms the signal. The bullish 3-method candlestick pattern is again simply reversed. And that is my favourite, most consistent candlestick patterns. I hope you enjoyed this video. If you did, please subscribe to Decisive Trading and also like the video. I intend to put together a full series of videos, exactly what I wish had been available to me when I started. They will lead you from complete beginner to trading mastery. I'm James Orr, and thanks for watching.
The Japanese candlestick chart. Get to know the main chart patterns. You probably think that financial analysis is complicated, but it actually comes down to 2 simple things: reading charts and reading news. There are many types of charts, but Japanese candlestick, or simply candlestick, are the most popular ones. Such a chart consists of red and green candlesticks, or candles, lined one after another. Each candle gives you detailed information about the price movement within a specified time interval. In fact, Japanese candlesticks are the best way to visualize the ups and downs of a price so that you can spot potential opportunities to buy or sell. Let's take a more detailed look. Every candle consists of a body and 1 or 2 tails called shadows sticking out of it. The body indicates the range between the open and close price for a specific time frame, and the shadows represent the highest and lowest price levels reached for the set interval. Japanese candlestick charts are easy to read. A red candle shows that the price is going down, and a green one represents an increasing price. If you're looking at a 10-minute chart, each candle represents a 10-minute time interval. We see a green candle when the open price is lower than the close price. If the price closes lower than it opened, then the candle is red. As simple as that. What kind of signals does a candlestick chart provide? It's no surprise that candlestick charts are so popular. They're excellent for spotting market turning points. By looking at the patterns that candles create, you can often guess if a certain market is about to continue in its current direction or reverse it. Patterns that show that the market could change direction are called reversal patterns. They could be bearish, ones that indicate the change from an uptrend to a downtrend that should be perceived as a signal to sell. Or bullish, these show that a price that has been decreasing is likely to start going up and we should buy. Let's see the most popular candlestick patterns which encourage you to buy. Bullish engulfing. The bullish engulfing consists of a red candle followed by a bigger green one, which fully engulfs the red candle. The pattern is an indication for a market turning point. In simple words, it's likely that the market may start going up and you can buy. The indication is even stronger if the green candlestick engulfs 2 or 3 red candles. Hammer. The name of this candle is pretty much self-explanatory. You'll recognize the hammer by its short body, lower shadow that is about 2 or 3 times the length of the body, and a shorter upper shadow, or no shadow at all. The hammer is usually a clear indication of a declining price reversing its direction and starting to go up, so you can start buying. But just to be safe, you could always wait for additional confirmation. Such confirmation is a green candle closing above the open of the hammer, for example. Morning doji star. This pattern appears when there is a slight market movement and consists of 3 candles, a red one, followed by a doji, followed by a green candle closing beyond the middle of the first candle. If the green candle is longer than the red one, the signal is even more reliable. Spotting the morning doji star is a signal to buy. Some chart patterns that mean you can sell. Bearish engulfing. This pattern is the opposite of bullish engulfing. A green candle is completely engulfed by a following red candle. When you spot it, you can sell, as the sellers on the market have possibly managed to overpower the buyers and the price direction could reverse. Dark cloud cover. The dark cloud cover appears before the price drops down. A long green candle is followed by a red one that opens at a new high and closes below the middle of the green candle. Keep in mind that when trading currencies, a second candle opening at a new high is rare, so the red candle usually opens at the close level of the green one. Once you see this pattern, you can go ahead and sell, or you can wait for another, smaller red candle to form and confirm the dark cloud cover. Shooting star. The shooting star is a red candlestick with a small body, long upper shadow and a short lower one. When it appears at the end of an uptrend, it shows you that you can sell, since the price, which has been rising up to that point, may start falling instead.